Bond rates are seeing a brief technical recovery today, but do not let that mask the broader reality. We are entering a highly volatile week driven by impending jobs data and global oil shocks. This chart shows the 10-year Treasury yield hitting 2026 highs last week before dipping today. Specifically, mortgage-backed security prices gained 3/8, and the 10-year yield dropped 7 basis points to roughly 4.37%. This drop is purely structural. It is driven by month-end positioning for March 30th and the defensive unwinding of trades ahead of the weekend. For originators and lock desks, this isolated dip is not a trend reversal. The underlying hawkish pressures in the market remain firmly in control. Those hawkish pressures are keeping the Federal Reserve sidelined right now, rooted largely in rising inflation fears and global energy shocks. This graphic breaks down the growing public pessimism. On the left, the final University of Michigan Consumer Sentiment Index dropped to a 3-month low of 53.3. On the right, consumers' one-year inflation expectations have sharply spiked to 3.8%. The primary driver for this pessimism is highly visible cost increases at the pump, fueled by escalating conflicts in the Middle East. Federal Reserve officials openly admit this combination of factors has created a fog that deeply clouds the near-term economic outlook. The Fed is explicitly warning that higher fuel and fertilizer prices risk transmitting into more durable inflation expectations. Until this fog clears, the market must price out any expectations of short-term rate cuts. The central bank is strictly on hold. This economic market forecast calendar details critical data dictating market movement. We're tracking Tuesday's JOLTS job openings, followed by Wednesday's ADP private payrolls and ISM manufacturing. Friday's main event, non-farm payrolls, is forecasted to add 55,000 to 60,000 jobs, with unemployment expected at 4.4%. Take note, Friday is an abbreviated Good Friday trading session, closing at noon. Take note of this. Because of low market liquidity, if the jobs report misses expectations, we will see extreme rate volatility. Looking past the rates and into local markets, it is time to firmly dispel the myth of a blanket housing shortage. Today, there is a record mismatch of 630,000 more sellers than buyers. The actual problem is the housing stock itself. The median owner-occupied home is 43 years old, and it sits in the wrong locations or at the wrong price points for today's buyers. Use this data to consult your clients. When you manage their expectations around imminent rate volatility and the true state of available housing, you position yourself as the undeniable expert. For further consultation and pipeline strategy, reach out to Regional Manager John McClellan.